Welcome. Today, we're stepping entirely away from the usual financial hype. No aggressive noise, just a highly effective, strictly mathematical market mechanic. As sophisticated practitioners, our goal is always the same, right? We want to decode capital-efficient strategies that protect our downside, while simultaneously generating systemic, repeatable returns. So, in this explainer, we're going to unpack a very specific blueprint. We're looking at how to leverage smaller portfolios, specifically how to systematically deploy $1,000 using a structure known as the PMCC. Our investigation today is going to follow a precise 5-part blueprint. We'll diagnose the capital inefficiency problem, understand the logic of synthetic stock, run the hard data, assess our systematic risk management, and finally, define our strategic edge.
Let's dive right in. You and I know that we do not rely on hope, and we certainly don't treat the markets like a casino. Well, unless of course we are operating as the house. The market is not a game of luck. It's a series of interlocking mechanics. By understanding this, we can use data, logic, and modern tools to isolate specific market inefficiencies and deliberately exploit them for our own capital growth.
Let's start with Section 1, the capital inefficiency problem. We really need to examine exactly why traditional professional income strategies almost always lock out smaller portfolios, and why a radically different approach is mathematically required if you're working with, say, a $1,000 account. You see, professional traders consistently generate income by selling time, specifically by utilizing the traditional covered call. But the collateral, that's the killer. To sell a cover call on a stock trading at $150, you have to own 100 shares. That instantly locks up $15,000 of your capital. If you only have $1,000 to deploy, you are mathematically locked out of this income stream. The PMCC, however, replicates that exact same profit potential, but with a massive 90% discount on our entry price. We are completely bypassing that capital barrier. Now, before we go any further, let's establish the precise technical terminology here, just to ensure we're all on the exact same page. While it's colloquially called the poor man's covered call, the actual architectural structure of this trade is a long call diagonal debit spread. By utilizing this very specific options spread, we're basically engineering a way to control 100 shares of a premium asset for a mere fraction of the standard cost. Moving on to Section 2, the logic of synthetic stock. So you might be wondering, if we aren't putting up the thousands of dollars required to buy 100 actual shares of a company, how exactly are we building the foundation of this position? Well, the foundational building block of our blueprint here is the LEAPS contract. That stands for Long-Term Equity Anticipation Security. In simple terms, it's just a call option that expires very, very far out into the future. Instead of buying actual shares to use as our collateral, we're going to purchase a LEAPS contract to act as our synthetic stock. But listen, we can't just buy any random contract. We have to strictly adhere to 2 golden rules to ensure this contract behaves exactly like real equity. Our first golden rule is securing 1 to 2 years until expiration. Most amateur traders fail simply because they buy short-term options, and they're slowly bled dry by theta, which is just the daily decay of an option's time value. By purchasing a contract that expires a year or 2 out, we effectively neutralize that theta decay monster. Our daily time loss becomes negligible. We're talking pennies rather than dollars. We are literally buying ourselves structural safety. Our second golden rule requires targeting an 80 delta. As you know, delta measures how much our option price will change for every $1 move in the underlying stock. By going deep in the money and purchasing an 80 delta, we're establishing an 80% correlation to the stock. If the stock moves up $1, our contract moves up 80 cents. We now essentially own 80 shares of the company, but we paid a tiny fraction of the standard share price. It's incredibly capital efficient. So the absolutely crucial point here is that we now own our synthetic stock via the LEAPS. We have a long-term lease on the asset. Now we switch to the income generation side. We put on our landlord hat and sublet this asset to other traders. We do this by selling call options against our LEAPS, specifically targeting contracts that expire in 30 to 45 days at a 0.30 delta. Why? Because this precise delta gives us roughly a 70% mathematical probability that the option we sell will expire completely worthless, allowing us to pocket 100% of that premium as pure monthly rent. However, there's a critical structural warning we must observe here. When you sell that 30 to 45-day call, you absolutely must pick a short strike price that is strictly above the break-even basis of your long LEAPS contract. If you fail to do this and the stock rapidly accelerates upwards, you could be forced to sell your synthetic shares for less than you paid to acquire them. And as sophisticated practitioners, we never ever structure a trade that guarantees a loss on the upside.
Let's look at Section 3, the data, running numbers.
It's time to transition from high-level mechanical theory into rigorous mathematical proof, using a real-world scenario. Interestingly, when we leverage modern AI-assisted quantitative screeners to run these numbers, the absolute superiority of our capital efficiency becomes undeniable. Let's look at a stock trading at $25. To run a traditional covered call, you have to spend $2,500 upfront to buy those 100 shares. For that, you collect $118 in monthly premium. Now consider the PMCC approach. We purchase a $15 strike leaps for $970. We sell the exact same call, and we collect the exact same $118 in monthly rent. We've preserved over $1,500 of our precious capital while our income yield remains identical. It's a massive edge. And the long-term systemic advantage of this strategy is profound. Because we're repeatedly collecting that monthly rent, we are constantly reducing the initial cost of our leaps. Think about it. In month 1, our cost basis is $970. By systematically selling time every single month, we drive that cost down. By month 4, our real risk is cut in half to $498. By month 8, our collected premiums have completely paid for the leaps. Our cost basis actually drops to zero. From that exact point on, we are holding a purely risk-free, income-generating asset. That brings us to Section 4, Systemic Risk Management. Because protecting our capital is always our highest priority, we must honestly examine our two primary risk vectors. Scenario A, the underlying asset rapidly appreciates past your short call strike. Novices tend to panic here, but this simply means you've achieved mathematically defined maximum profit. Your brokerage will exercise your leaps to cover the short position, and you walk away with a profit difference. It's a win. Scenario B is the real risk. The stock crashes. Yes, your leaps will lose value. However, look at the capital exposure. Because we utilize the PMCC structure, our maximum possible loss is strictly capped at our $970 entry, whereas the traditional trader is sitting there holding $2,500 of rapidly depreciating equity. Our structural risk is inherently minimized. Which brings us to a vital risk mitigation tactic utilized by professionals. Do not hold your short calls to expiration simply out of greed, just trying to capture the last few pennies of premium. If your short call achieves 50% of its maximum profit in just a few days or weeks due to a favorable price movement, you buy to close the position. You lock in your mathematically optimized gain, you clear your risk off the table, and you simply wait to sell the next cycle. Finally, Section 5, the strategic edge. So how do we take everything we've decoded today and deploy it systematically? We execute a highly repeatable workflow. Step 1, buy your deep in-the-money leaps to establish your synthetic equity with minimal theta decay and high delta. Step 2, sell 30 to 45-day out-of-the-money calls to generate your monthly rent. Step 3, manage your risk by closing those short calls early at a 50% profit. And Step 4, repeat the cycle endlessly to systematically reduce the cost basis of your leaps down to zero. By executing this loop, we remove emotion entirely and operate with a strict mathematical edge. A truly crucial filter for this entire strategy is asset selection. Please do not attempt this mechanic on highly volatile, unproven penny stocks. You should leverage algorithmic screeners, perhaps even AI-driven volatility analysis, to strictly deploy this blueprint on highly liquid blue-chip assets. We're talking companies like Apple or Microsoft. High liquidity ensures tight bid-ask spreads, which means you can enter and exit these complex option spreads smoothly and fairly. Furthermore, you should only run this mechanic on assets you possess a fundamentally bullish long-term thesis on.
And that brings us to our final question for you today. We've decoded the logic, we've analyzed the data, and we've established the systemic edge required to leverage a $1,000 portfolio safely. The mechanics are now in your hands. So which highly liquid blue-chip asset will you apply this capital-efficient logic to first? Analyze your watch lists, run the numbers, and see for yourself. Keep your downside protected, stay analytical, and we'll see you in our next explainer.